Okay, so let's just go through some basic purchase transactions. This is when, again, you are buying inventory from your vendor. Okay, so it's just, if we go back here, it's this transaction here. Okay, that's what we're dealing with here, where you are talking to your vendor and you're buying inventory, and it's going to be put into this inventory asset. Okay, so this is the transaction that we're talking about. So very simple. You have an asset, debit, inventory, and in this case, we're paying cash. Okay, so your asset, no change. You have one asset going up and one asset going down. We can also have this case where we're buying with an account payable. Okay, so we have an asset going up, but we have liability also going up. So our accounting equation is still kind of okay. So everyone okay with this? This is just the purchase of an asset either with cash or with a account payable. So we've seen this before. Okay, so there's going to be now just a little bit of extra flavor thrown in here because of this purchase discount. So let's talk about that. If we're buying, and it's really only relevant for this situation. Okay, this is the only time where this credit term situation applies, because if we're paying for cash, there is no purchase discount. We're closing out the transaction in one shot. We're just giving the vendor cash. Okay, so there is no it's a moot point. This credit term is not relevant for a cash purchase of inventory. It's only relevant if we're have an account payable. So I guess we're now kind of clearing this out. So we've made this account payable, and now we're going to pay it off, and we're going to basically get a discount. Okay, so we're assuming that we get a 3% discount. Okay, so when we initially bought the inventory, we accounted for the full value of it, 25,000. But we're not actually paying 25,000. Look, we're getting a little discount. This is the amount of cash that we're actually transacting. So our inventory asset is not worth 25,000. It's only worth 24,250 because we bought it. That's how much we actually bought it for. Okay, so we have to reduce the inventory by that discount amount. So you can see here, this 750, it's going as a credit here. And so now my ending inventory balance is correctly lined up with how much cash I paid. Okay, so on the front end, we have this inventory, right? This is where it was created, but it's unclear whether we're going to actually pay 25,000 because we have that discount available. Okay, so in this case, we say that yes, we paid within the period of time to get the discount. We're getting a 3% discount, and so we're going to have to clear this account payable. We no longer owe the full amount, so we want to make sure that this is zero. We calculate how much cash we're paying, which is this times 97%. That's how we get to this cash amount. And then to make the journal entry balance, we need more credit, and it's going to go to inventory. And it's because initially this inventory was overstated. It's not actually worth 25,000. It's worth 24,250. So now, again, the inventory value is correctly aligned with how much we actually paid for the inventory, which is what we want, right? We want that inventory to reflect the value of that inventory. Okay, so the other part of this is returns. Okay, so oftentimes you will return, maybe they sent you the wrong items or they're defective, or there's going to be instances where your business needs to return inventory. Okay, so it's pretty straightforward. You're just going to reverse the entry that you did to buy the inventory by whatever by the return amount is. So you can see here, we initially bought 25,000. We're just going to swap the accounts. Okay, or I guess this is how it's supposed to be. But if you look up here, we have inventory debit, accounts payable credit. We're just going to swap those. We're going to do accounts payable debit, inventory credit. You can see now that these are correctly lined up with how much they're supposed to be. Now, there's another thing called an allowance. The difference between a return and an allowance is whether you keep the items. So a return is when you actually physically give the items back. An allowance is like, I don't know if this has ever happened to you, where you order something on Amazon and it's like the wrong thing, and you call in and you're like, hey, you sent me the wrong thing. They're just like, keep that item, we'll send you the new one. That's an allowance. Okay, so you're not going to pay for that thing that you have in inventory. That the cost to you is zero, right? If they allow you to keep it. So if you were to sell it, it would just be pure profit, right? So your inventory is not gonna reflect that cost because you actually like didn't pay for it. Okay, so the journal entry is the exact same. Even if they allow you to keep it, you're still gonna pay them less, right? You're only gonna pay them 24,000. Even if you said, hey, this $1,000 item, I don't want it anymore. They're like, okay, don't worry about it. Just keep it. We won't charge you for it. That's essentially what is happening here. So if you did sell it, right, because it's physically there, you would only just record a revenue. There would be no cost of goods sold because it didn't cost you anything. If your vendor just gave you stuff for free, it would be pure profit, right? You'd have no expenses, right? So in this case of the allowance, that could happen. Freight cost is going to depend on the terms, right? So if it's FOB your place that you want it, there's no freight, right? The seller is going to pay for the freight to get it to your location. If it's FOB their location or some other midway point, you will have to pay for freight. Okay, so again, this is specific to purchase transactions where you're buying inventory. You're going to capitalize that cost. You're going to hold it as inventory. It's going to be part of your all-in cost of how much you paid for your inventory. So you can see here that actually not only do we have to pay, like capitalize or keep in inventory the 25,000 that we paid, but also this $500 freight cost. And then when we sell these items, all of this will become cost of goods sold, including the freight. But only when we sell those items.